Well, hello, everyone. Thomas Montgomery again. I'm with the Institute for Improved Minority Financial Literacy. We're one of the three collaborators on this message. This is on financial management for a small business. Many of you are enrolled in our small business certification. And as we'll see, this is the third module of the four. So you're over halfway there. Stick with it. You're doing a great job. With that being said, please understand that this is an award-winning curriculum. It was developed by the FDIC, promoted by the SBA, and our nonprofit is very fortunate to have been selected exclusively to administer this small business certification program for aspiring and early stage entrepreneurs. What makes this program really powerful is not only the educational message like we'll be going through together today, but it is the model whereby we help you implement what you've learned. Because there's lots of information out there on the internet and elsewhere, but the real power is learning something and then applying it. So keep in mind, we're going to get you very, very involved with implementing what we're learning today after you've gone through this curriculum. Now, there are a couple resources you need to be aware of. The YouTube that you're listening to now, the recording of this lesson. And again, this is most likely the third lesson that you've completed. We first went through business planning, and then we started your business plan with financial projections. Hopefully you've done that. Secondly, we talked about business credit as well as personal credit. And then from there, we should have worked with you prior to today's session on pulling your doing the soft pull for your personal credit, putting together your personal financial statement. Hopefully that sounds very familiar. If not, get with us and we'll get you plugged in. And you also should have a participant's guide. If you don't have that, I would pause the recording and get that from us, because the participant's guide is a very useful tool for you to reference after this lesson. Again, this is the hands-on approach. That's why we received the grant to do it this way, is that we're not just going to talk about it today. We're going to actually work with you individually to implement. So that will come through typically an assigned financial literacy educator. And the specific homework after this lesson, before lesson 4, which is on banking and money, is to complete your FNA, your financial needs analysis. Okay, so our agenda, we have the welcome, which we've just done. In your participant guide, there is a pre-test. To no surprise, afterwards, there'll be a post-test and also an evaluation. It's great if you take a moment to complete the pre-test now, the post-test later, and the evaluation, because that gives us good feedback. We're going to talk about the benefits of financial management. We're going to talk about budgeting. We're going to talk about bookkeeping. And as we're going through this, you may have one of two perspectives of, oh, wow, there's some deficiencies I have in my understanding of some of this. By learning more, I can help more successfully and hopefully more profitably operate a business. Or the other school of thought is, oh my gosh, I'm not really interested in the numbers or any of this. But as a small business owner, these are crucial topics to understand. And frankly, if you want to go get financing, which many of you want to do, to go raise capital to start or grow a business, these are crucial topics. So even if it's painful, please go ahead and stick with it and do this, because they're essential elements to being able to raise capital in most cases. We're going to also talk about financial statements, the 3 different types of financial statements and how to obtain those. We'll talk about business financing, and then we'll wrap it up with some key points to remember. Now, I think I've shared with you before in one of the earlier lessons, there's kind of a hidden agenda here, right? We're going through this educational message, but what we're really doing in the background is putting the pieces together so we're ready to help you go to funding after the 4th module. And we call that the loan package. We're going to talk more about what loan packages are and what's included in them explicitly in today's training. but even like the PFS, the personal financial statement that you should have completed before today's lesson with your financial literacy educator, and the business plan from week 1. Frankly, we've been working on your loan package already. You might just not have realized it. And then again, as I mentioned, we'll wrap it up with a summary, a post-test evaluation, and then you'll be getting with your financial literacy educator to complete the personal needs analysis prior to lesson 4. All right, learning objectives include to explain the concept of financial management and its importance to a small business and its owner, identify financial management practices, rules, and tools commonly available to small businesses, explain how financial management practices, rules, and tools work. Furthermore, we're going to explain financing basics. And so this is going to blend into lesson 4, which we'll go through next week on banking and money. But we're going to start introducing these concepts this week, which include startup financing, financing for a growing business. And so what do I mean by the difference there? So startup means that we've not flipped the switch on yet, right? Our business is not yet operational. We need money just to even get it going. And then once we are open for business, it's not unusual that most small business owners need additional capital to grow. There's very few business models that are consistent with just growing based upon your earned income and your profit. And we'll talk about what profit technically means here in a few minutes. So it's not unusual. It's not a bad thing. I don't want you to confuse the consumer perspective with the business owner perspective. You'll often hear that consumer debt is bad. I'm not here to argue that. But business debt or business financing is leverage, and it's very, very difficult and unusual. It's possible, but it's difficult and unusual for a small business to be able to reach its potential without additional capital. So that's why this is very relevant. This isn't something of, oh, no one wants you to know about this because it's bad for you. It's just the opposite. It's almost essential for most small businesses to succeed and reach their potential. We're going to talk about financing working capital, which is different than financing fixed assets. Financing working capital is different than fixed assets, and we'll talk more about that here in a few minutes. What are some benefits of financial management? Well, it's going to help you reach your goals by making good decisions. And by that, I mean you'll be able to know your profitability. There's many small businesses that I've visited with, both as when I was with the SBA and now with IIMFL, that they're often lacking the quantifiable data about their business to know how they're doing. And so we need to manage a little more tightly than that. We're going to help you with that. And that includes knowing your profitability to be able to forecast your growth. That's good in general as a business owner. But if you're looking for third-party financing, it's imperative that you're able to show what you think will happen, and your projections will probably change over time. But if we can't even project that we're going to be profitable in the future, why in the world would someone want to loan us or invest in us capital? Because there's even less certainty that they'll be able to recognize a return on their investment. Financial management is also important if we start to plan for diversification, new product lines, and reaching new markets. We're recording this as of September 2020, but this is extraordinarily relevant for what has happened this calendar year. There's many small businesses that went out of business this year because of all the economic circumstances. But conversely, many of those that are still operating and some even thriving typically have pivoted. They've changed something about their business based upon the market conditions. And that's what we're getting at here with diversification, new product lines, and reaching new markets. There's restaurants, for example, that didn't offer carry out or delivery 6 months ago, that if they wouldn't have adopted that alternative method of business and embraced it, they wouldn't be here today, for example. We also recognize the benefit of financial management, which is preparing for financing. I think a common misnomer with small business owners is I want and or need money for my business and I'm going to go get it. But that's rarely the way that it works. There's almost always a preparation phase. It's like saying if you wanted a new home, well, I'm just going to go build a new home. Well, first of all, you might need some help because you may not have that skill set, but maybe you do. But we need to put together the plans and figure out from those plans, what type of inventory do we need? How much wood do we need? How many windows of what sizes do we need? So this is where we so often see small business owners fail, is the lack of preparation for financing. And we're going to help you with that. All right, so from a budgeting perspective, there are several financial management practices and tools commonly used for small businesses. Budgeting is one of those. Now, in your participant guide, there is a sample budget, but I'll tell you right now, we're not going to spend any time on that. If you want to look at that at your leisure, you can, because we're going to work with you on your numbers. And that's, again, the power of our program, not just some textbook learning, but let's learn a concept and apply it. So again, the participant guide is wonderful. You can reference it. You can see the sample budget, but we're going to work with you on helping you create and manage your budget. So let's move forward. Now, from a bookkeeping perspective, this is a critical component. You'll see on a few of the slides, I've added some highlighted yellow, and maybe this is a bullet that I should have highlighted yellow, because it's crucial that we use an organized process of tracking income and expenses. Putting it in an Excel spreadsheet does not meet the expectations that I'm talking about. Just simply tracking money in and out of your bank statement by using your monthly statements is not what I'm talking about. We need to have an organized process. So this is the basis, bookkeeping is the basis for all financial management, business decisions, financing, taxes, owner's draw, and retirement. What I'm getting at here is frankly, you need to be using a software like QuickBooks. It doesn't have to be QuickBooks. It could be Peachtree or other types of accounting software, but I'm going to use QuickBooks just as a generic term. You must begin using QuickBooks. Now, you can implement it yourself in-house or you can outsource that. That doesn't really matter, but we're not running a business properly if we're not using a software like QuickBooks, because it's crucial for proper management. And as you're going to see as we go through today's topic, it is instrumental in being able to get third-party financing in most cases. Bookkeeping steps. So how do we go about having a bookkeeping system? Well, we need to get the software. QuickBooks, I used to teach QuickBooks as a high school teacher to high school students in an entrepreneurial course. So, you know, those freshmen and sophomore knew more than most small business owners do. But the bottom line is QuickBooks or a software like that used to be available on CD where you'd buy it and put it in your computer. Now most of them are cloud-based, which is great because it allows for seamless interface with your CPA. So for example, for us, we do use QuickBooks Online and our CPA has access to it. So anytime that we need help or guidance or preparation for tax returns or for financing or for other uses, the CPA has immediate access to that. And of course, if we change CPA relationships, we could deactivate Linda's access and put someone else's in. So it's not that I'm suggesting that you're losing control of your information, but it allows for you to collaborate with your trusted partner, which should be a CPA firm. Secondly, we do need to have a separate business checking account. And in some cases, you may want to have a couple separate business checking accounts, but we'll talk about that one-on-one after the course here. But we need to have at least one. We don't want to be commingling in. I've had clients that all their money came through PayPal, so they had a PayPal account. So like, well, I don't need a business account. Everything's in PayPal. No. We need to have a true business checking account. And as this bleeds over into topic 4 next week on banking and money, the bank that you open your business checking account with is a crucial ally for you, and probably one of the resources that we'll be leveraging to access capital for your business if that's the assistance that you need. Reconciling your checking account. So just because you have, well, I should back up. With QuickBooks, it's really sweet because you're able to attach your business checking account and the data automatically reconciles, it automatically uploads. Therefore, if you went to Office Depot or somewhere and bought office supplies for $35, it's not as painful as it used to be where you'd have to go put that entry in to QuickBooks or your accounting software. Now it'll upload all the transactions from most major banks. That is awesome. It saves a lot of time and it removes one of the excuses you might have had of not doing this. But number 3 is still relevant. We still need to reconcile, and the reconciliation needs to be done monthly. We need to track sales, and so that means that we know the amount of sales that we're making, and we're depositing the revenue from all sales into our business bank account and recording it in our accounting software. I know some of you operate in either businesses that are largely or at least partially cash pay. And for instance, we work with a client that is a hairdresser, and she's not putting hardly any of her money into her business bank account. Well, separate from all the legality and ethical issues with that, that's terrible for what we're trying to accomplish, because now we're lacking the tracking, the ability to manage from that. And then as we're trying to help that client get financing, their business looks much, much, much smaller than it actually is, because she's kind of pilfering out all of her money. Is it her money? Yes. And we're not having ethical lessons here. But the bottom line is, if we're trying to run a business properly and cleanly, we should record all sales in our financial software like QuickBooks, which is also reflected as revenue in our business and for our tax returns. Furthermore, step 6 on bookkeeping steps, we need to use business checks for business expenses and business credit cards for business expenses. We don't want to combine. So it's not best practice to use a personal credit card and then reimburse yourself, or then pay that credit card bill out of the business account. We need to try to separate as much as possible. Again, we can help you with some of these steps if it seems a little overwhelming. Pay business expenses first. And so what this means, and this could be difficult, but if money's tight, you should be paying your business expenses before you're paying yourself. Now that may not feel good, but the underlying problem, if we have to make that decision of which bill to pay because we don't have enough, we need to come up with some ways to increase our income, and we'll talk about that and access financing maybe. But we need to pay our business expenses on time. We need to be able to generate financial statements, and the most important of those is called either the income statement or profit and loss. They mean the same thing, and we're going to talk more about those here in a couple slides. But having the data in a software like QuickBooks allows the generation of these reports to be just a push of a button. It's easy. And also allows us to see if maybe we didn't record everything correctly. If we're not using software and using proper bookkeeping steps like we're talking about, then this becomes very difficult, if not impossible. And that's not good for your business, and it's going to be a significant impediment for getting financing. Again, we'll help you get over this hump if needed. Now, number 10 is interesting, and this is a little bit controversial how I'm going to say it, but we don't want you to look self-employed. Well, what does that mean? Self-employed means where you're just pulling money out of your business for your own use. And it's your business. We're not saying that you couldn't do that or shouldn't do that. but how you pull the money out and how it's recorded makes a tremendous difference. So we are big advocates for setting up a salary for yourself through your business. Now, again, don't throw up a blockade and say, well, if I had money to pay myself a salary, I'd do that, Tom. But as soon as possible, we need to do that and pay yourself a reasonable salary where there are payroll taxes deducted. And now you're thinking, well, that's too difficult. I don't know how to do that. Well, again, if you're using QuickBooks or something like that, then there are payroll services that interface. They're very affordable, very, very, very easy to use, and they'll do the filings to make sure you're compliant. If you set yourself up on a reasonable salary, then you're going to actually lower your taxes, because then when you take profit distributions above that, those profit distributions are now no longer subject to employment taxes. So certainly the amount that you're paying yourself a salary is subject to employment taxes, but the rest isn't. So for many of us, that will actually lower our total tax liability. It'll increase our compliance. We're feeding money into Social Security, so we have that as part of our retirement. And then also it's going to make life so much better when you're trying to get financing. Here's an example. Let's say that you went to buy a home. And if you go to the bank and they ask you, Tom, are you self-employed? And I say yes, then there's a whole bunch more hurdles I have to jump through that I may or may not make through, and I may not be getting a mortgage. But if I go in and say, no, I'm a W-2 employee. Now, I might be a W-2 employee of a company that I have ownership in, but if I'm a W-2 employee and I have consistent paycheck stubs, and we're not talking about manufacturing fake paycheck stubs, we're talking about paycheck stubs that match the deposits went into my personal account, then getting a mortgage is a snap. Getting auto financing is a snap. So this is not my opinion, this is a fact. Most of the banking and lending world sees self-employed as highly risky, where they think employment is much less risky. So if you can position yourself to be an employee of your company, then access to capital for many uses will be much more readily available. Key point, I probably should have highlighted it in yellow. So financial management software makes it easy to organize and complete daily accounting tasks, to create these types of reports like we're talking about. There are three main financial statements, and we'll talk about those. Cash flow is one, and helps you track the financial health of your business. I don't know if any of you are sports fans. I am. And so after the game, I'm equally as interested in looking at the stats. For instance, we have our local high school football team is undefeated so far. So I love looking at the stats after the game. What were the passing yards and the rushing yards, the key metrics? Well, there's key financial metrics for your business that you need to be paying attention to and monitoring. And if that doesn't seem natural to you or not comfortable to you, or you don't know how to do that, that's okay. We will help you, and we'll help you do that after this 4-week course is over. But that's what the proper approach to business management should be. And we'll teach you that you should be doing that. And if you need help implementing doing that, we will do so. And as I mentioned a minute ago, just tracking on paper, the old shoebox method, Excel spreadsheets, what have you, is not acceptable. We need to use formal small business accounting software. Does not mean that you need to be an accountant. You could certainly go to your local community college or take an online course on QuickBooks, or you can outsource parts of that to a bookkeeper or CPA. But it's an important, and in my opinion, a non-negotiating point. If you're not willing and ready to use some sort of accounting software to track your revenue and expenses and do these things we're talking about, you're really not ready to run a small business. And again, it may not be what you want to do. You could outsource it to a third party, but it needs to be done. It needs to be done. Okay, more on financial statements. So financial statements are reports about a business's financial health and cash flow. There are three main basic financial statements, and I referenced that a moment ago. There's balance sheets, and we'll talk about that more in a minute. We're going to help you analyze your balance sheet rather than doing more with these case studies. But balance sheet shows assets and liabilities. and owner's equity. Cash flow projection, sometimes called a cash flow statement. And again, we'll dig a little bit deeper into that today, and then we'll look at yours here after the course. And then the profit and loss statement, sometimes known as P&L or income statement. So we'll talk more about each of these over the next couple slides, but these are the three main financial statements. If you had a test off of today's course, this would certainly be a question, wouldn't it? Name the three main financial statements of a business: balance sheet, cash flow, profit and loss, or could be referred to as income statement. Okay, so for balance sheets, there is an example on pages 10 through 13. I'll teach you the main topics here, and then again, I'm more concerned about your balance sheet than I am some theoretical balance sheet in the participant's guide. But let me back up for a second. So it is important to understand that a balance sheet is for one specific point in time. So prior to today's course, you should have worked with your financial literacy educator and done your personal financial statement. Well, that was as of a specific date. Now we're talking about a business balance sheet that's for a specific date, because things change, right? The difference between today and tomorrow, I might have less or more cash in my account tomorrow versus today. Well, then it would be accurate as of tomorrow, not as of today. So it's a snapshot in time. Typically, we'll look at these on a monthly basis, and it's going to list assets and liabilities, which I'll pull that little simplified example up. So there's an accounting formula, and we taught it when I taught accounting, and it's assets equals liabilities plus owner's equity. What that means simply is the left-hand side of this little grid needs to equal the right-hand side. And again, when your financial literacy educator just worked with you on your personal financial statement, which you should have completed prior to today's lesson, same thing. It had the left-hand side, which was assets, and the right-hand side, which was liabilities and net worth. Here, we have assets on the left, things that we own that have value. We have liabilities, which is debt, and the difference between assets and liabilities in our business is our owner's equity, which in this case is $35,000. Again, don't worry too much. Just try to understand the concept. We'll review your financial statements with you. All right, so cash flow statement, which is the second financial statement. What is cash flow? There are two primary definitions of cash flow. The first of which is the balance of cash received less than the amount of cash paid out over a period of time, typically over a 1-month period, but could be longer. So in other words, did we have more money come in than went out, or did we have more money go out than come in? You might say, oh, it would be very bad to have more money go out than come in. Well, not necessarily. There can be certain points where maybe we're buying extra inventory, and so we have an expense, a lot more paid out this month because now we're going to have inventory in place for the next selling season or what have you. That this helps us understand really the financing need of a small business, because it's very rare that cash flow is going to be stable. There's going to be some months there's more money coming in than others, and some months there's going to typically be more expenses than others. And so the timing of it is crucial, right? We could say, oh, I'm projecting I'm going to make $1 million next year. Well, you could still go out of business even if you would have made $1 million if you didn't have adequate cash on hand to service your cash flow needs during the course of the year. The second definition is it's just simply cash moving in and out of a business. We need to do cash flow projections for the reason that I just mentioned. It is one of the three financial statements, and we need to forecast the company's money coming in and out, future cash flow during a specific period, and to project whether cash receipts will be sufficient, as I was describing. Because cash is king in business in general, but especially in small business. And there's been many businesses that have failed, not because it wasn't a good idea or not because the owner wasn't a good owner, but we just didn't have adequate cash flow. And so that's why we need to do the projections. So how can a cash flow projection help, and when do I need one? Well, we need it to set sales and expense goals. So in other words, we might say, uh-oh, we're going to have some greater expense in October. Maybe we need to really ramp up some sales in September to make sure we have the cash on hand. Or maybe we want to look at how we can manage some of our other expenses, because there's some like inventory expenses that's going to hit at that time for maybe the holiday season. We need cash flow projections to be able to determine our break-even point, to plan for equipment purchases for replacement or expansion, determine cash needed to purchase inventory for seasonal cycles, like the example I gave you. Now, how can a cash flow projection help? When do I need one? Well, we need to track liquidity when accrual accounting masks cash realities. What did that just mean? So there's two main ways that a business can track their revenue: on the cash basis or accrual basis. And this is just a Cliff Notes shortened version. So let's say that I own a lawn care company, and I sold a client, and they bought a 6-month program for lawn care, and it's $100 a month, just for simple math, for 6 months. They've paid me, so I've got the contract signed, but they paid me $100. How much money did I make? Well, in accrual accounting, I made $600 because I signed an agreement. I have $100 cash. I have $500 accounts receivable. In cash accounting, I made $100 because that's all that went into my bank account. Well, you can see how the cash accounting system is off, because really I have another asset. I have a promissory note from this customer for $500, $100 a month for the next 5 months. That really reflects what my sales were this month. I just sold a $600 project, not a $100 project. But the point is, cash flow projection can differ quite a bit from accrual accounting, as that example just showed you. Cash flow projections, as we suggested earlier, is needed to help determine, do we need financing and how much financing? It's really interesting. I work with a lot of small business owners, and I'll ask, okay, how much capital are you looking to raise? And either they don't know, or they'll just blurt out a round number, $100,000. Well, how did you come up with that $100,000? And chances are most small business owners have not properly used cash flow projections to truly anticipate what their capital raise needs is. And so we need to be more exact, to be more professional, to be more diligent in the financial management of our small business. And then also the cash flow projections help shows lenders our ability to plan for and repay financing. So for example, if we want to go get that $100,000 loan, what do we need to put in the cash flow statement? A payment each month for the cash, for the expense, the loan payment of that $100,000, right? Because just because we get $100,000 in doesn't mean that we don't have to pay it back. If it's debt-based, if it's equity-based, it's different. And so that's another common mistake that we see of small business owners. Sure, they want to borrow money, but we're not even integrating that debt into the projections going forward. How do you think that makes the lender feel? Oh, okay, you want $100,000 from me, but you have no plans to repay me. Oh, no, I'll pay you. Well, it's not in your cash flow projection. It's not in your income statement, and so forth. So we're going to spend more time on your numbers than fictitious numbers, but simply put, a cash flow projection has a couple key categories: sources of cash, operating uses of cash, and then non-operating uses of cash. We won't worry much about this theoretical example. Instead, we'll go through all this with your numbers. Okay. This is a projection out of the participant guide, but I left it in because the solutions that are here for this suggested business probably match up pretty well to what you could do or any other business could do. So again, if you want to go through the participant guide more, that's fine. I'm more worried about your numbers than those example numbers. But let's just focus on what this slide says. To increase cash flow, what could you do? Well, we could sell more, right? We could sell more of the products or services to generate more cash flow. That's a really good way to increase cash flow, is to increase sales. And a little bit of a tangent, maybe even a soapbox, but I'll have often small business owners come and all they're worried about is borrowing money, borrowing money, borrowing money. And it's like, are we paying equal attention to making sales? Because sales is key to being able to qualify for financing, to repay financing, and to grow a business. So sales should probably be our number one focus. How can we sell more? How can we sell more? Number two, maybe we could increase the price of each unit sold, and that would also increase cash flow. Because remember, that's what we're talking about. We're looking at a theoretical example in the guide, but we're talking about in general, what can you do to increase cash flow? We can either sell more, and or we can increase the price, and or we could reduce our expenses, right? So we can, by using proper financial management, we can see where we're spending money, and it might surprise you. So reducing expenses is another strategy to improve cash flow. Change the timing of expenses. I know for our business last month, is this month, we paid $9,000 to DocuSign because we use DocuSign as the software to execute agreements with clients. Our bill this month was over $9,000. And so, what crossed my mind? Well, maybe we should reduce the use of DocuSign, or maybe I should give DocuSign a call and see if I can break that into smaller payments. So we can reduce expenses, but we could also maybe try to change the timing, maybe even work with the vendors to change terms. We also, they might also want to make sure that they have enough cash on hand to get through these difficult times. Continued. They could look at sources of cash other than sales. So maybe they do need to go get a line of credit or a business loan to inject more cash to help absorb the period of projected negative cash flow. They could look at the money that they're taking out for their own point. Now, what I mentioned earlier is we really would prefer that you set up a W-2 payroll service and pay yourself a salary. While it's possible to defer your salary, this is less about that on number 7 than any additional profit distribution. Maybe you want to reduce that or defer that so you have available cash flow for your other business needs. Negotiate with your vendors to buy inventory at a lower price, or even get credit, net 30, net 60, some other terms from the vendor so you have more time to pay the bills. And then also maybe just simply work with your client or clients, your customers, and do some sort of incentive, offer some sort of incentive where they pay early or pay ahead of time. And I've frequently seen this. No one's probably traveling much right now, but earlier in the year, if you'd go to some hotel sites, sometimes they would give you a prepaid discount, because normally when you book a hotel room, they might put a credit card on file, but usually they don't charge it until you come in to check in for your room. But I know the Hilton family of hotels started to offer a discount. Pay now and save 5% or save 10%. That's an example of a policy to get customers to pay sooner than they normally would have. All right, so the second financial statement that we'll talk about, I guess the third, we talked about the balance sheet and the cash flow. Now we're on to P&L, otherwise known as the income statement. It is measuring revenue and expenses over a period of time. So this is different. This is different than the balance sheet. The balance sheet was only true for one date. It's like dropping a pin in the sand, putting your pencil on a calendar. For that date, that balance sheet was accurate. Same for the personal financial statement that we helped you create before this lesson. But a profit and loss statement is looking at over a period of time, often a month, sometimes a quarter, could even be a year, but it's over a period of time. And it's tracking profitability. Are we making a profit on what we're doing? Now, a profit and loss statement shows how successfully the buying and selling process has been managed, measures the ability of your business to grow, repay debt service, and support you. And I hinted towards this earlier. This is the most important. All three financial statements are important. This is the most important, the most important. And again, if we're using QuickBooks or software like that, generating the P&L is not a problem. It's a report that's generated with a couple of clicks of the mouse. Now, what is the basic formula for profit and loss? It's revenue minus expenses, right? But here we see it's sales minus cost of goods sold equals gross profit minus overhead equals net profit. But the simple way to say is it's revenue minus expenses equals profit. Net profit is important. Net profit is the reason we are in business. Now, you might have a very strong mission, you might have some very strong philosophical beliefs of why you're here, but if you're a for-profit business, not a non-for-profit, if you're a for-profit business, your responsibility is to generate profit. That's why businesses exist. So net profit is ultimately more important than gross sales, isn't it? Because we could sell $1 million, but if it cost us $2 million to sell the $1 million, then we've lost money. So it's all about net profit, that bottom line. This is what we need to be able to get paid ourselves and share in profits, to fund expansion of equipment and other purposes, to repay loans if we're borrowing money, and to pay income taxes. Now, I'll tell you, I understand that the intuition, the instinct that you probably have is, well, I don't want to pay taxes, right? I don't want to pay taxes, so I want to burn out all the profit that I have before I do my end of the year tax return. Well, think about that. If your goal is to position your business for a capital raise now or in the future, if you're not showing profit, that doesn't look near as strong to the lender. So I'll let you work with your CPA on those details, but just keep in mind, those are almost two contrary strategies. One is, how do I minimize my taxes on my business? And the other is, how do I position my business for a capital raise? You see? And again, generating the profit and loss statement is easy if you're using QuickBooks or something of the like. Again, there's a sample profit and loss statement in the participant guide. I don't really care much about that. I care about your profit and loss statement and your numbers. And so we'll work with you going through a similar set of questions with your numbers rather than worrying about these theoretical examples in the guide, but you're certainly welcome to use that. All right, so we move on over into business financing. Well, what is business financing? It is financing to get the money that you need to start, operate, and or grow your business. So there's some concepts with basic financing. There's a difference between equity financing and debt financing. So let's do debt first. Debt is money that we borrow. We might borrow it from a family member, a friend, a bank, a credit union. We might get an SBA loan or a non-SBA guaranteed loan. It might be a line of credit, it might be credit cards, could be funding for real estate. Doesn't really matter, but debt financing simply means we borrowed money and we promised to pay it back. Equity financing is money that we don't have to pay back, at least not the same way. So equity financing is where someone, could be you, could be friend, family member, angel investor, venture capitalist, whomever, injects money into your business. Well, why would they do that? It's not a charity, right? None of this we're talking about is a charity. We're talking about running a for-profit business. Well, equity financing occurs because the person that's injecting, or the organization that's injecting money into your business, anticipates a positive return on investment, and that usually happens one or more of two ways. Either through appreciation of the company, so it grows, so it's worth more, the stock is worth more, and or profit distributions like dividend payouts. And then we also need to understand that there's a difference in philosophy and strategy of financing working capital versus fixed assets. So we do a lot of SBA guaranteed working capital loans up to about 150,000 are called express loans. Those can happen pretty quickly, and they're certainly available to start up businesses. But we're going to ask you, right? So, okay, we're helping you get that $150,000 SBA loan. Great. We're asking, what are you going to use those funds for? Well, I'm going to go buy equipment. Well, we should use different financing for that, because if you're buying equipment, real estate, or so forth, that's a fixed asset, and we need to match the type of financing that we're getting based upon how you're going to use the money. But we'll get into that during our individual discussions. So do's and don'ts of small business financing. Highlighted in yellow here, so that means it's crucial. It's crucial. You have to identify the right source of capital based upon your circumstances. Probably the number one mistake that we see from small business owners is they group everything into one bucket, and they think, oh, what do I need to do to qualify for that one type of capital, or I don't qualify for it. We do in-person trainings here in our offices every Friday. We had one gentleman that was drove 6-8 hours to come in. We had other people that flew in from around the country, but he had a question that I could tell he didn't grasp this. This is specifically recognizing that not all small business owners will have the same type of capital raise. Not all small business owners qualify. And so just because one small business owner gets a certain type of a capital raise, that does not mean that others will qualify, or that's the best type of capital raise for them. So there's an art to this, and that's matching the right type of capital based upon the owners and the business's circumstance. The second do of small business financing is you probably need to anticipate investing your own money. Now I say this, and sure enough, I met with someone yesterday, and he's a personal trainer, very successful. He's opening a retail shop, and sure enough, as I prepared to give you this today, he didn't invest any of his own money. He got investors, and they put all the cash up because he had the idea and the credibility. But in general, don't expect to open a business and raise capital without any of your own skin in the game. That's rarely going to happen. And let's go back to that. If we're going to go for a business loan, SBA or otherwise, remember, many different sources of capital, and they don't all operate the same. That was this first highlighted yellow, right? Don't combine the requirements for capital type 1 to capital type 2 because they're different. You might qualify for one, you might not the other. Number 1 might require the use of personal credit. Number 2 might not use personal credit at all. But the point here is that if we're going to go after a traditional bank loan, including SBA guaranteed loans, they're not going to loan you 100%. They're going to look that you're bringing some portion of that to the table. So is it impossible to get 100% financing for a small business? No, it's not. But what I'm trying to convey is that for traditional loans, that's normally not going to happen. Okay, we need to earn the right to borrow. Some people feel a little bit of entitlement, and it's like, well, they should give me a chance. They should give me a loan. No, we've got to qualify. We have to meet the underwriting criteria. And if we meet the underwriting criteria, then they're going to loan us the money. And you know what's going to happen if we don't meet the underwriting criteria? We're not going to get money, at least from that capital, that source of capital. And part of that is this preparation that we're doing together now and the packaging of getting the pieces together, which we're going to talk more about today and continue to work with you on. We need to show profitability, and here's just a simple example. Let's say our company brings in $10,000 a month, but we were told, well, you don't want to pay taxes, so you need to spend $10,000 a month. So again, just simplified example. So every month we bring in $10,000, but we spend $10,000. We bring in $10,000, but we spend $10,000. It could be a little bit of variation each month, but let's just say that's the plan we have. So now we want to go borrow $100,000, and they go look at our bank statements and our interim financial statements and our tax returns, and none of it shows that we can afford to pay back that $100,000 loan because everything that we make, we spend. There's nothing left over. So this is consistent with the point I made earlier There's two different strategies here. If your goal is just to not show profitability to minimize taxation, that's one strategy. But to position your business for access to capital is a different one, and that would include showing profitability. We need to understand and keep working capital. We need to have access to adequate working capital because things will happen. Clients will come and go. Unexpected expenses will pop up. Pandemics might occur. And so we need to have cash on hand. We need to have working capital. If you don't, let's work together and resolve that because it's too stressful and it's too volatile to run a business without adequate working capital. Be lean on fixed assets. And what that means is if you go out and for instance, we have a lot of clients, well, I shouldn't say a lot. We frequently have clients that come to us and they're pre-launch. So we're putting together their loan package and they not only need working capital and money for this and that, they want to go buy a building. And it's like, well, why do you want to go out and buy a building? Why want to be a business owner? Well, that's a whole nother set of responsibilities. That's asking for a much larger capital raise. And it's a bigger outlay, right? Because you're going to have to bring probably 10, 20, 30% down typically to finance a commercial building. And then you're going to have other expenses. And then every month that mortgage is due, rather you've leased out part of that space or whatever you're doing with it. So fixed assets, we want to try to minimize early on because those are unforgiving expenses. If you apply that to your household, if you want to go buy another car or a more expensive car, now that bill's there every month. And if something disrupts your income, that bill's still there. The bill didn't go away just because your income's lower this month. And then we need to match sources and uses of funds. And that's what I referenced earlier. If we're looking for a working capital loan, that is most appropriate for working capital. If we're wanting to go buy fixed assets, company vehicle, real estate, equipment, so forth, then we should use longer term financing that matches the expected lifespan of the asset. Okay, some more do's and don'ts for small business financing. Understand your financial statements. Obviously, this lesson today takes a step towards that, and we'll work with you on that. And our goal is to help you every month review those financial statements, make sure that we're on track, and not just make this a 4-week curriculum, but really help you on a going forward basis. Understand collateral options. It's not unusual. Now, again, not all sources of capital have the same underwriting criteria, right? We've talked about that, so don't generalize this. But in many cases, especially traditional business loans, they will look for collateral. And so we need to think about what is our collateral going to be. But again, we've had many instances where we help clients get $20,000, $50,000, $100,000 of uncollateralized funding. So different sources of capital, but if we're thinking about a business loan or even an SBA guaranteed business loan, collateral is going to be involved. And so we need to work on that, and we're going to help you create a collateral assignment and get that put together. We need to understand the risk and costs for any type of loan. Don't expect grants. Now, I realized with the pandemic that the PPP came about and that's almost free money, but that's unusual. That's not the norm. That's not going to continue to be around. That's not a sustainable part of planning for a successful business, of chasing after a grant. In general, there's not going to be grants for for-profit businesses in general. Now, we're in a 100-year-old historic building. Could we go apply for a grant and do some new exterior upgrades and on awnings and that? Yes. But in general, don't hope for grant money to help your for-profit business reach its potential. That's the exception, not the norm. Shop around. Again, there's SBA guaranteed loans, non-guaranteed loans. I can tell you that when we work with clients, we could take one client loan package to 3 different banks, and there may be one that approves it and 2 that don't, because they have different appetites for different types of deals. So again, avoid the temptation to lump everything into one bucket and think, well, there's only one type of capital or one place to get money. That's not the case. Get expert advice, and we need to build the loan package. What we don't want to do is go to the bank before we're prepared. Frankly, nothing good happens, because we've seen deals not go through because and I'll say this not meaning negatively, the naive small business owner goes into the bank, knocks on the door, starts to have a conversation with the business lender, the business banker, doesn't have his or her stuff together, and the first impression is not good. You know, the first question might be from the banker to you: how much money do you need, and what are you going to use it for? We need to have an articulated, specific answer to that. Not, oh, I don't know, 50, 75,000, doesn't really matter. Whatever I can get. That's the worst answer. Whatever I can get. So don't do that, please. Let's build your loan package first and then take that to the lenders. Don't go to the lender unprepared. It will statistically and unquestionably reduce your probability of getting funding. In terms of getting ready for a loan, we need to have a business plan, and we started that after week 1, didn't we? On live plan, putting together the business plan and the financial projections. We need to be reasonable with knowing what we can afford. Again, I'll often have small businesses that come to us and they're asking for amounts that are absurdly high as compared to their circumstances. And that's not a knock against them. You know, if I wanted to go compete against Elon Musk and form some competitor to SpaceX, that's unrealistic, at least at this point in time. I don't have near the package that would be needed to go get $1 billion of financing. Does that mean that the financing system is corrupt or profiled to be against me? No, it's just I don't qualify for $1 billion financing. If I want to, I'm going to have to do some work to get there. And so we don't want to fall into the trap that just because we have an idea that we may have to take my point is we may have to take incremental steps to get to where you want to be. Not everyone's going to qualify for $1 million right away. Not everyone's going to qualify for $100,000 right away. We have different tranches of capital. We may have to take steps to get to the end result. We need to study and know our financial statements, which we've learned about those today. We need to check your credit report, and we should have done that after lesson 2, after the last lesson. We should have done a soft credit pull with you. We need to establish collateral options, and your financial literacy educator is going to meet with you to start working on that after this lesson. We need to demonstrate your equity contribution, because in general, if you don't have skin in the game, it's going to be very difficult to get financing. It's possible to not be the case, but it's unusual. We need to go through and look at different financing options. And again, key to that is looking at what the right type of capital is based upon your mitigating circumstances. And again, we want to build your loan package before you go apply. We need to be prepared before we go in. Have your resume put together before you apply for a job. I don't know if that's a good analogy or not, but that's the best one I come up with on the fly. All right, so common elements of a loan package, the business plan. We must include the uses of funds. Again, I told you we have training here at our office every Friday, and we wrote this on the board, and we were redundant going through it. A good business plan just doesn't say, oh, I want some money. We got to specifically state, well, how much money do we want? How are we going to use it? And how do we propose to pay it back? We're going to help you put that together, and we should already be working on that after week 1. But my point here, don't think of just a business plan. We need to be very specific in our uses of funds. We need our financial statements, and that's one of the reasons we have this lesson in this certification curriculum, is that most small business owners are not able to generate balance sheets, income statements, and cash flow statements, and that's not good for management of their business, and it's certainly not good for accessing capital. So we need to be able to do that. personal financial statements, and we should have completed that with you prior to today's class. Personal and business tax returns. Now, if your business is brand new, it wasn't around in prior years, then of course you wouldn't have a business tax return in prior years. We understand that. Personal, we should be filing every year. There's some clients we've had that haven't for a variety of different reasons. Again, keep in mind, each source of capital has a different underwriting criteria. Not all sources require the same things. There are some sources of funds that we can go get tomorrow with you that don't even ask for tax returns. So we're not saying that this is the list that is applicable in every circumstance, but for traditional loans, SBA guaranteed or not, this is the list. So elements of a loan package also should include sources and amounts of equity contribution. So how much did you contribute? When did you contribute that? And how did you contribute that? A credit report, ideally both personal and business, and that's part of what we do with you, for you through this curriculum. We need to identify collateral as part of our loan package. And again, your financial literacy educator should have an appointment with you here soon to go through that, as well as the financial needs analysis. And then if we're buying things, we need the purchase agreements, the appraisals, the contracts. If we're going to buy real estate, do we have a survey? Do we have appraisal and so forth? So it's whatever documentation that we can bring. Now, what I found to be really successful is, especially if we have letters of commitment. Let's say we're starting a new business, but we have letters of commitment from certain customers. We did this with a gentleman. He worked as a mechanic, made about $90,000 the prior year as a W-2 employee of this auto shop, but wanted to open his own. And so with him, we were able to actually get some letters of intent from some fleet clients to include in his loan package. Can you imagine how much stronger that was than when we went to the lender to say, sure, it's going to be a startup business. Sure, my client has experience. He's a certified mechanic, but here are the clients we're bringing to the table. Do you have any cash flow for your business yet? No, it's pre-launch. We need funding to get it started, but here are some letters of commitment we have. So that really makes the loan package stronger. How do you go about qualifying for a loan? Again, you see the asterisk at the end, different sources of capital have different underwriting criteria. Different types of loans have different criteria, including credit scores and so forth. But let's go through the normal list. Normally, for a loan, you need a good credit score. If you don't have a good credit score, we can either help you improve your credit, or we need to pivot away from a source of capital that cares about credit, or bring a cosigner in. But for a normal business loan at your bank, SBA guaranteed or not, to no surprise, a good credit score is important, because that's reflective of have you paid your bills on time as agreed in the past. We need to show our equity contribution, as I mentioned, especially for traditional loans. There's exceptions otherwise, but for normal business loans, they're going to want to see that you've put skin in the game, that we have the ability to repay it, right? It's not like we can have been unsuccessful running our business in the past, and now we plan to go borrow $100,000, and we're going to use that $100,000 to pay back the $100,000. Well, that's not a good idea, right? We need to be able to use that $100,000 to do something different, to generate more sales, more profitability, so we can afford to pay it back if we didn't have the available cash flow before. Looking at our loan to value ratio, and I'll use real estate as an example for that, because we frequently work with real estate investors. And so if we're going to buy a property and we're going to pay $100,000 for it, but it's worth only $50,000, then there's a problem. Now, of course, rehab costs and so forth could fit into it, but it's looking at the difference between how much are we looking to borrow versus how much it's worth. So again, in highlighted yellow, there are different sources of capital, and each have different underwriting criteria. So that's what we're going to do, is put this loan package together, and make sure that we're pursuing the right types of capital based on your circumstances. Now, startup financing. So let's say that we're pre-launch. As this gentleman here, he's not even up and into the run yet. He's getting into his stance. Where do we get money from for startup financing? Well, certainly equity-based is good and popular, and that could be money that you put in or money that other people put in. Because equity-based financing is more based upon where are we going and how does the future look, where debt-based financing typically has a more higher level of scrutiny of past performance. Sweat equity just means that we're putting time in and maybe not drawing a paycheck right away, so we're foregoing our income from it. Business credit cards. We've had a lot of success with business credit cards, and we can do business credit cards under the EIN. We've done it. I think the most we've done is 108,000. Now, again, you might say, well, that's a bad idea. It depends upon your uses of funds, right? If we're going to go buy long-term assets with credit cards, that's a terrible idea. We talked earlier that we need to match. But if it's to give some working capital, because a business credit card, quite frankly, works just about like a line of credit. It's almost exactly the same. If you use it, then you have to make a payment. And if you don't use it, it's available, but you don't have any expense, any interest expense, and no payment. But business credit cards are a good option, and we can get those under the EIN. Business loans, of course. Now, you might think, well, I can't get a business loan as a startup, or I have to be in business at least 2 years. That is not true. There's a lot of people that will tell you, as a matter of fact, you have to be in business 2 years to get an SBA loan, for example. That is not the case. That is not the case. If you want to question what's truth, then you go look at the SOP, the standard operating procedures of the SBA. And secondly, you look at case studies, history. And I can tell you that we've worked with clients that were pre-launch, not even in business 2 months, let alone 2 years, and absolutely got business loans. So it's possible. Does that mean that it's not easier the longer you've been in business to get most business loans? Well, of course, you got more track record, but don't write off business loans just because you're a startup. Certainly getting money from family and friends is not unusual in the early phase as well. All right, so where should you look for a loan? Certainly, we recommend, as we discussed earlier, let's work together. Let's get this loan package put together before we go apply for loans. But regardless of that, where do you look for a loan? To no surprise, banks. And I would start with the bank that you have an existing depository relationship, the bank where you have your business checking account. They know you better than anyone else, and that it's not unusual. Often we'll help clients open a business bank account with the bank before we even turn around and go apply for financing there, because it tends to increase the probability of approval. And then there are other types of lending organizations. And then thirdly, there's specialty lenders that do specific things like inventory financing or getting a company car for you. So there's different types of lenders, much different than what you see when you're driving around your community, that have specialized purposes that may be the right fit for you. All right, so what are some key points to remember? Financing is getting the money you need to start, operate, or grow your business. I mean, to start with a budget. Sound bookkeeping is very, very important. And we need to get QuickBooks or something like that and start using it internally or outsource it. There are 3 financial statements: the balance sheets, cash flow statements, and profit and loss, also called income statement. Very important for internal management and to get capital. We need to do everything we can to try to separate personal and business records and funds. And then keep in mind, we need to pursue the right type of capital based upon your circumstances. There are different sources of capital and each have different underwriting criteria. Again, for example, some look at credit, some don't. Some do look at time in business, some don't. Some look at collateral, some don't. Some look at cash flow and some don't. So it's crucial that we pick the right piece of the puzzle to be able to get your financing. It's not a one-size-fits-all approach. If there's any questions that you have, we certainly encourage you to reach out to us. But again, we expect your financial literacy educator to be in contact with you soon. As I've mentioned before, we love doing this class in person. And when we do it in person, of course, these questions can be asked live and you can give us live responses. But nonetheless, if you have questions, jot them down and we'll certainly help you with them. We hope that you can reflect back on what you've learned. And there's been a lot of valuable information in this module. This is one of those modules you may want to go back and listen to a second or third time because you might pick up a little bit more. I know for me, sometimes when I watch a movie, I'll watch a movie a second time. It's like, oh, wow, I didn't even remember that from the first time. So don't hesitate to maybe listen to this lesson again and really get prepared for your discussion with your financial literacy educator. There's an evaluation in your participant guide. We would appreciate it if you'd fill that out, good, bad, or ugly, and then you'll give that to your educator as well. We are looking to teach this to more people, and we can teach more people online like you're going through it, or we can actually come in to a set location, teach all 4 lessons in one day and knock it out in one day versus 4 weeks. So if you'd like to help us teach it or even just help facilitate making introductions to churches, chambers, associations, and organizations, please let us know. You can generate some income for doing that, and we can help more people together. If you have questions, get with your financial literacy educator, or don't hesitate to email us. And you see our email there, support@iimfl.org. All right, so in conclusion, what we've learned about what financial management is and why it's important. We learned about common financial management practices, rules, and tools. We learned about financing basics such as startup financing, financing a growing business, financing working capital, financing fixed assets. And we talked a little bit about why it's different of how we want to get financing for working capital than long-term assets, right? Okay, so we get the post-test and evaluation, which are in your workbook. If you've not done so already, go ahead and assess what you've learned beforehand and then afterwards. The evaluation form, as we mentioned, is important for us to know how we're doing. And then most importantly, highlighted yellow, most importantly, set up your appointment with your assigned financial literacy educator and let's get that financial needs analysis done. That's the next step. If you have questions, you can get back with us. We're committed to your success. This concludes the 3rd educational module. We only have 1 more to go, and that's on banking and money. And then after that, we'll be putting together the package so we're ready to go to funding. But we have 1 more lesson, and we'll do that in about 1 week. What we want to do right now, though, is get with your financial literacy educator, have him or her answer questions you have, and let's get this financial needs analysis completed. Thanks, everyone. See you again soon. Have a good day.